Why is everyone suddenly obsessed with what happens this Friday? What makes the market close on a Friday so different from any other day of the week? I'm going to show you something that most investors completely miss, and it's costing them dearly. Because while everyone's watching the daily price movements, there's a pattern that repeats every single week, and it's creating opportunities that vanish the moment Monday morning arrives. Let me paint you a picture of what's really happening. Every Friday afternoon, as the markets prepare to close, something fascinating occurs in the precious metals markets. The big players, the institutional traders, the commercial banks, they're all making their final moves before the weekend. And here's what most people don't understand. The weekend is a black hole for market participants. 72 hours where anything can happen in the world, but the markets are frozen. No trading, no ability to react, just you, your positions, and whatever chaos might unfold between Friday's close and Monday's open. Think about that for a moment. In our hyper-connected world where news breaks every second, where geopolitical events can shift the entire landscape overnight, where central banks can make announcements that shake the foundations of currencies, you've got this massive gap, and the smart money knows this. They've known it for decades. That's why Friday's close isn't just another day, it's the last chance to position yourself before the unknown. Now, gold and silver, they're not like stocks. They're not like bonds. They're real assets, physical stores of value that have survived every empire, every currency collapse, every financial crisis in human history. And right now, as we're seeing record highs being tested, as central banks around the world are accumulating at unprecedented rates, the Friday close takes on even more significance. Because the forces moving these markets aren't slowing down for the weekend. They're accelerating. Let me show you what I mean. Central banks have been net buyers of gold for over a decade now, but the pace has intensified dramatically. We're talking about hundreds of tons being purchased quarter after quarter. The People's Bank of China, the Reserve Bank of India, the National Bank of Poland, they're not buying gold because they think it might go up a few percentage points. They're buying because they see what's coming. They understand that the global monetary system is under stress like never before. And when do you think they prefer to make their moves? When the markets are open and everyone's watching, or when they can accumulate quietly, when the weekend provides cover for their activities. Here's something most people never consider. The COMEX, the major exchange where gold and silver futures are traded, it closes on Friday afternoon. But the world doesn't stop. London is still trading for a few more hours. Asian markets will open Sunday evening their time. And in that gap, in those hours and days when the primary price discovery mechanism is shut down, real physical metal is still changing hands. Real demand is still there. Real supply constraints are still binding. But the paper market, the derivatives, the leveraged positions, they're frozen. Quick thing before we go deeper into this. I put together a free guide that shows the saving secrets thousands of American retirees are using to protect their hard-earned wealth. It's in the description below. Grab it while you're thinking about this, because what I'm about to show you is going to make you want to take action. So what happens when there's a disconnect between the paper market and the physical market? What happens when the price discovery mechanism is offline but real-world demand continues? You get distortions. You get opportunities. You get moments where the market hasn't yet priced in what's actually happening in the real world. And by the time Monday morning rolls around and the COMEX opens again, sometimes the gap is massive. I want to take you back to a specific example that illustrates this perfectly. Remember the weekend when Silicon Valley Bank collapsed? It was a Friday when the news really started to break. The stock market had already closed. But gold traders knew what was coming. They knew that by Monday morning there would be panic. There would be a flight to safety. And sure enough, when the markets opened, gold gapped up significantly. The people who positioned themselves before that Friday close, they captured that entire move. The people who waited until Monday, they were chasing the price higher. But it's not just about crisis events. It's about the systematic pattern of how markets behave around the weekly close. Professional traders, the ones managing billions of dollars, they have something called weekend risk. It's a real calculation they make. How much exposure do we want to carry over the weekend when we can't react to events? And depending on what's happening in the world, depending on the geopolitical climate, depending on economic data releases scheduled for the weekend or Monday morning, they adjust their positions accordingly. Right now, we're in an environment where Weekend risk is elevated across the board. You've got tensions in multiple regions globally. You've got central banks navigating inflation while trying to avoid recession. You've got currency wars playing out in slow motion. You've got the de-dollarization trend accelerating as countries seek alternatives to the US dollar for international trade. Every single one of these factors can explode into a major market-moving event at any moment. And if it happens on a Saturday, the gold market can't react until Monday. But you can position yourself on Friday. Let me break down the mechanics of what actually happens in these markets as Friday approaches. The futures market, where most of the price action occurs, it's dominated by two types of players, the commercials and the speculators. The commercials are the big banks, the mining companies, the industrial users. They're hedging real physical positions. The speculators are the hedge funds, the trading firms, the momentum players. They're betting on price direction. And every week, as Friday approaches, you see a dance between these two groups. The commercials, they have deep pockets and long time horizons. They can afford to carry positions over the weekend because they're hedging real business operations. But the speculators, they're often leveraged. They're using borrowed money to amplify their bets. And leverage cuts both ways. If the market moves against you over the weekend and you can't exit your position, you could face a margin call on Monday morning. So what do speculators do as Friday approaches? Many of them reduce their positions. They take profits. They cut losses. They flatten out to reduce their weekend exposure. And here's where it gets interesting. When speculators are reducing positions, who's on the other side of those trades? Often it's the commercials, the smart money, the patient money. They're accumulating when others are reducing exposure. They're building positions at better prices because the weekend sellers are creating temporary supply. And then, when Monday comes and the speculators want back in, guess who's selling to them at higher prices? This pattern repeats week after week after week. It's not a guarantee, nothing in markets ever is, but it's a structural feature of how these markets operate. And right now, with gold testing all-time highs and silver showing incredible relative strength, this Friday pattern is more important than ever. Because we're not just talking about normal market conditions. We're talking about a potential breakout scenario where the next move could be explosive. Let's talk about what's actually driving these metals right now. Because understanding the fundamentals helps you understand why Friday's positioning matters so much. Gold has broken through resistance levels that held for years. We're seeing fresh highs, and when gold makes new highs, it's not just a technical event, it's a signal. It's the market telling you that something fundamental has shifted. And what's shifted is the perception of risk in the global financial system. Central banks are buying gold at the fastest pace in decades. Why? Because they're diversifying away from dollar-denominated assets. They're preparing for a world where the dollar's dominance is diminished. They're building reserves of the one asset that has no counterparty risk, that can't be printed into existence, that has maintained its value across millennia. And when central banks are buying, they're not trading in and out based on weekly price movements. They're accumulating for strategic reasons. They're thinking in terms of years and decades, not days and weeks. But here's what creates the opportunity for individual investors. While central banks are buying steadily, the paper market, the futures and options market, it's still dominated by short-term traders. And those short-term traders, they create volatility. They create price swings. They create moments where the price temporarily disconnects from the underlying fundamentals. And Friday's close is one of those moments that happens every single week. Silver. Now silver is even more interesting because it's got this dual nature. It's a monetary metal like gold, but it's also an industrial metal. It's used in solar panels, in electronics, in medical applications, in batteries for electric vehicles. The industrial demand for silver is growing exponentially as the world transitions to green energy. But the supply is constrained. Most silver comes as a byproduct of mining other metals. You can't just turn on more silver production the way you might drill more oil wells. It takes years to bring new mines online, and the existing mines are depleting. So you've got this setup where industrial demand is surging. Investment demand is increasing as people seek inflation protection, and supply is tight. That's a recipe for a significant price move. And when that move comes, it's not going to wait for a convenient time. It's not going to happen during regular trading hours with plenty of warning. It's going to happen suddenly, probably triggered by some event that catches most people off guard. And if that event happens over a weekend, The people who position themselves before Friday's close are going to capture the entire gap up on Monday. I want to tell you about something that happened in the silver market that perfectly illustrates this dynamic. There was a weekend several years back when a major silver ETF announced they were having trouble sourcing physical metal to back their shares. The announcement came out on a Saturday. The market couldn't react. But by Sunday evening, when Asian markets opened, silver was already trading significantly higher in overseas markets. When COMEX opened on Monday, there was a massive gap. The people who were long silver going into that weekend, they made substantial profits overnight. The people who wanted to buy on Monday were paying much higher prices. Now, I'm not saying every weekend is going to have a major announcement. Most weekends are quiet. But that's exactly the point. You don't know which weekend is going to be the one where something significant happens. And in today's world, with geopolitical tensions elevated, with economic uncertainty high, with monetary policy in flux, the probability of a weekend event that moves markets is higher than it's been in years. Let me talk about something that doesn't get enough attention: the physical market versus the paper market. When you trade gold and silver futures, you're trading contracts, derivatives, paper promises. The vast majority of these contracts never result in physical delivery. They're settled in cash. But there's a real physical market underneath all of this paper trading. Real bars of gold sitting in vaults. Real silver coins and rounds being bought and sold. And sometimes the paper market and the physical market diverge. We've seen this happen during periods of stress. The paper price might say gold is trading at one level, but try to buy physical gold, and you're paying a premium above that price. Or try to get delivery of a large quantity, and you face delays. This divergence is a warning sign. It's telling you that the paper market isn't accurately reflecting the real supply and demand dynamics. And when this divergence gets large enough, eventually the paper market has to adjust to reality. And that adjustment can be violent and sudden. Right now, we're seeing signs of stress in the physical market. Premiums on physical gold and silver have been elevated. Delivery times have been extended. Dealers are reporting strong demand. Meanwhile, the paper market continues to trade with massive leverage, with positions that dwarf the actual physical metal available for delivery. This is a powder keg, and the fuse could be lit at any moment. Here's where the Friday close becomes critical. If you're holding paper positions, futures contracts, you're exposed to this potential disconnect. If a crisis of confidence in the paper market happens over a weekend, you can't exit your position. You're stuck. But if you understand this risk, if you position yourself appropriately before Friday's close, you can either protect yourself from the downside or position yourself to profit from the chaos. Let me shift gears and talk about something that affects everyone watching this, whether you're actively trading or not: your retirement accounts, your 401k, your IRA. Most people have their retirement savings in traditional assets, stocks, bonds, maybe some mutual funds. And those assets are all denominated in dollars. They're all subject to the same systemic risks. If the dollar weakens significantly, if inflation erodes purchasing power, if the stock market corrects sharply, your retirement savings take a hit. And here's the thing: you can't time these events perfectly. You can't wait until the crisis is obvious to everyone, because by then, it's too late to protect yourself at reasonable prices. This is where physical precious metals in a retirement account come in. A gold IRA allows you to hold actual physical gold and silver inside a tax-advantaged retirement account. You get the same tax benefits as a traditional IRA, but instead of being fully exposed to paper assets, you've got real tangible wealth that's protected you through every financial crisis in history. Now, if you've got $100,000 or more in retirement accounts, I put together a comprehensive guide on how gold IRAs work. It's in the description. It covers how to move funds from existing accounts without tax penalties, how the physical metal is stored, how it's protected. It's worth looking into, especially given everything we're seeing in the markets right now. The geopolitical instability, the monetary policy uncertainty, the potential for a significant market correction. These aren't theoretical risks anymore. They're real and present dangers to your financial security. Anyway, back to why Friday matters so much. Let's talk about the technical side of the market, because the charts are telling us something important right now. Gold has broken out of a multi-year consolidation pattern. When you see a breakout like this, especially on high volume, it's usually the beginning of a larger move, not the end. The technical analysts call this a continuation pattern. The market consolidates, builds energy, and then breaks out in the direction of the prevailing trend. And the prevailing trend in gold is up. It's been up for years when you zoom out and look at the bigger picture. But here's what happens after a breakout. You get volatility. You get pullbacks. You get tests of the breakout level. And during these tests, weak hands get shaken out. People who bought near the highs get scared and sell. Short-term traders take profits. And this creates opportunities for those who understand what's really happening. The Friday close is often when these shakeouts occur, because traders don't want to hold risk over the weekend. They sell, the price dips, and then Monday morning, when the real buyers come back in, the price recovers and continues higher. Silver's chart is even more compelling in some ways. Silver has been lagging gold for years, trading well below its previous all-time highs. But recently, silver has been showing relative strength. It's been outperforming gold on up days. This is a classic sign that silver is preparing for a catch-up move. And when silver moves, it doesn't move gradually. It explodes. We've seen this pattern before. Silver will be quiet for months or even years, and then suddenly, in a matter of weeks, it doubles or triples in price. The people who are positioned before that move capture life-changing gains. The people who wait until the move is obvious are buying at much higher prices. Now let's connect this back to Friday. If you believe, based on the fundamentals and the technicals, that gold and silver are in the early stages of a major bull market, then every Friday close is an opportunity. It's a chance to add to positions at potentially better prices because of the weekend risk premium. It's a chance to position yourself before potential weekend events that could gap the market higher on Monday. It's a strategic advantage that repeats every single week. But there's another dimension to this that I want to explore: the psychological dimension. Markets are driven by human emotions, fear and greed, hope and despair. And these emotions are amplified around the weekend. Think about it. If you're holding a large position in gold or silver going into the weekend, and you're worried about a potential negative event, that worry builds throughout Saturday and Sunday. You can't do anything about it. You can't exit your position. You're stuck with your anxiety. And come Monday morning, if nothing bad happened, you feel relief. But if something did happen, you feel regret. This psychological pressure affects how traders behave on Friday. Some people can't handle the weekend stress, so they reduce positions. Others see opportunity in that selling and accumulate. The market becomes a battleground between those who fear the unknown and those who embrace it. And over time, the people who can handle the psychological pressure, who can think clearly about probabilities and position sizing, they tend to come out ahead. Let me give you a framework for thinking about this. Every Friday, you should be asking yourself, what's my weekend risk? What events could potentially happen that would significantly move the gold and silver markets? Is there a major economic data release scheduled for Monday morning? Is there a geopolitical situation that could escalate? Are there central bank meetings or policy announcements coming up? If the answer is yes, then you need to decide, do I want to be positioned for that potential volatility, or do I want to sit it out? There's no right or wrong answer. It depends on your risk tolerance, your time horizon, your conviction in your analysis, but the key is to be intentional about it. Don't just hold positions by default. Don't just sell by default. Think about what could happen and position yourself accordingly, because the traders who are making consistent profits in these markets, they're not lucky. They're strategic. They're thinking about these dynamics every single week. Now let's talk about what's happening in the broader economy, because it all connects back to why precious metals are moving and why Friday's positioning matters. We're in this bizarre situation where central banks are trying to fight inflation while also trying to prevent recession. It's like trying to drive a car while simultaneously pressing the gas and the brake. Something's got to give. And when it does, when either inflation spirals out of control or the economy tips into recession, or worst case, we get both simultaneously, that's when precious metals really shine. History shows us this pattern over and over. In the 1970s, when inflation was raging and the economy was stagnant, gold went from $35 an ounce to over $800. That's not a typo. It multiplied more than 20 times in less than a decade. Silver did even better on a percentage basis. And the people who recognized what was happening early, who positioned themselves before the crowd, they preserved and grew their wealth while everyone else saw their purchasing power evaporate. We're seeing echoes of that period right now. Inflation has been running hot. Central banks have been raising interest rates to try to cool it down. But the underlying problems, the massive government debts, the unfunded liabilities, the structural issues in the economy, those haven't been solved. They've been papered over with more money printing, more debt, more can kicking, and eventually the can reaches the end of the road. When that happens, when the next real crisis hits, gold and silver are going to be the assets everyone wants, and the price is going to reflect that demand. But here's the thing. You can't wait until the crisis is obvious to everyone. By then, prices will have already moved significantly. You need to position yourself before the crowd realizes what's happening. And Friday's close, every single week, is an opportunity to do that. Let me paint a scenario for you. Imagine it's a Friday afternoon. The markets are about to close. Gold is trading near all-time highs, but has pulled back slightly during the day. Silver is showing strength, but hasn't broken out yet. You're watching the news, and there's tension in the Middle East. There's a debt ceiling debate in Washington. There's a central bank meeting scheduled for the following week. What do? Most people do nothing. They're paralyzed by uncertainty. They wait to see what happens. But the smart money, they're making a calculated decision. They're thinking, if tensions escalate over the weekend, gold gaps higher on Monday. If the debt ceiling situation worsens, safe haven demand increases. If the central bank signals more dovish policy, that's bullish for precious metals. The probabilities favor being positioned long going into the weekend. So they buy. They accumulate. They build positions while others are hesitant. And then Monday comes. Maybe nothing happened over the weekend. The market opens flat. No big deal. They hold their positions because the fundamental reasons for owning gold and silver haven't changed. But maybe something did happen. Maybe there was a significant development. And the market gaps up. And they've captured that entire move while the people who waited are now chasing the price higher. This is how wealth is built in markets. Not through luck, not through gambling, but through understanding the dynamics, recognizing the patterns, and positioning yourself strategically. And the Friday close is one of those recurring patterns that creates opportunity week after week after week. Now, I want to address something that might be on your mind. You might be thinking, if this Friday pattern is so obvious, why doesn't everyone do it? Why isn't it arbitraged away? And the answer is, because it requires discipline, patience, and the ability to handle uncertainty. Most people can't do that. Most people are driven by emotions. They buy when they feel confident, which is usually after prices have already risen. They sell when they feel scared, which is usually after prices have already fallen. They're reactive instead of proactive. The Friday close strategy requires you to be proactive. It requires you to think ahead, to anticipate, to position yourself before the move happens. And that's psychologically difficult for most people. It feels uncomfortable to buy when there's uncertainty. It feels risky to hold positions over the weekend when you can't react to events. But that discomfort, that risk, that's exactly what creates the opportunity. If it was easy and comfortable, everyone would do it, and the opportunity would disappear. Let's talk about the supply side of the equation, because it's crucial to understanding where prices are headed. Gold mining production has been essentially flat for years. The easy gold has been found and mined. New discoveries are rare and expensive to develop. It takes a decade or more to bring a new mine online, and the ore grades, the concentration of gold in the rock, have been declining. Miners have to process more and more material to extract the same amount of gold. This means production costs are rising, which puts a floor under the price. Silver's supply situation is even more constrained. Most silver comes as a byproduct of mining other metals like copper, lead, and zinc. Only about 30% of silver production comes from primary silver mines. This means silver supply is largely dependent on the economics of these other metals. If copper prices fall and copper mines shut down, silver production falls too, even if silver prices are high. This creates a supply inelasticity that can lead to explosive price moves when demand surges. And demand is surging. Industrial demand for silver is growing because of its unique properties. It's the best conductor of electricity. It's highly reflective. It's antimicrobial. It's essential for solar panels, for electronics, for medical applications. As the world transitions to renewable energy and electric vehicles, silver demand is projected to increase dramatically. Meanwhile, investment demand is also rising as people seek protection from inflation and currency debasement. You've got growing demand meeting constrained supply. That's a recipe for higher prices. But here's what makes Friday's close so important in this context. The supply and demand fundamentals don't change day to day or week to week. They're slow-moving structural forces. But the price can be volatile in the short term because of trading dynamics, because of speculation, because of weekend risk management. So you get these situations where the price temporarily disconnects from the fundamentals, and those disconnections create opportunities for those who understand what's really happening.